Picture the man famous for shorting the 2008 housing market. I mean, you know the exact image I'm talking about.
Oh, definitely. The guy who famously wore the cargo shorts.
The cargo shorts, the nerdy glasses, just casually preaching global financial doom from his office. For years, he was like the ultimate financial predator.
Always hunting for the market's weakest links.
Exactly. Looking for that exact moment when everyone else just loses their minds. But the math, the math tells a totally different story. But fast forward to 2026, and his radar is locked onto something entirely new.
Right, he's not looking at real estate anymore.
No, he is looking at Bitcoin.
And we are seeing a level of urgency from him right now that, honestly, it mirrors his posture right before the subprime mortgage collapse.
Yeah.
He is out there actively dismantling the current market structure piece by piece.
But there's this massive, fascinating contradiction at the heart of today's deep dive. Because on one hand, Michael Burry is currently out there warning of a catastrophic Bitcoin death spiral.
A total systemic collapse.
Right. He's talking about a contagion that will drag down traditional portfolios. But on the other hand, he recently made this brutally honest admission. He actually almost bought Bitcoin back in 2013.
Which is wild to think about.
It is. He looked at it, he ran the numbers, he passed, and he openly acknowledges now that he missed the trade of a lifetime.
And that admission really changes the entire context of his current warning.
How so?
Well, when the architect of the greatest contrarian trade in modern history admits to a blind spot, it means his updated models are designed specifically to correct that past failure.
So he's checking his math twice.
Exactly. He is absolutely determined to understand the underlying mechanics that he missed the first time around.
So you have a guy who admits he missed the boat, and now he's screaming that the boat is going to sink and take the rest of the harbor down with it.
Right.
Is he a visionary trying to save you from market contagion? Or is he just, a cynic who missed the train and now wants to derail it?
Yep.
Our mission for this deep dive is to figure that out.
We have a lot of ground to cover.
We really do. We are going to unpack the Michael Burry 2.0 thesis. We'll dissect why he passed on Bitcoin in 2013. We'll examine the intricate mechanics of his terrifying 2026 market contagion warning, and we'll figure out how Bitcoin went from this rebel tech project to a massive Wall Street risk. Okay, let's unpack this.
We really need to start with the anatomy of that 2013 decision.
Yeah, let's go back there.
Because understanding why a mathematical genius passed on the most lucrative asset of the decade tells us everything about how traditional finance fundamentally misjudges the asset.
Let's set the scene for you guys listening. It's 2013. Bitcoin is trading for basically pennies on these obscure internet forums.
It's definitely not on Wall Street yet.
No, definitely not. It's not in heavily marketed ETFs. Burry is sitting in a meeting at Lightspeed Venture Partners. Someone pitches him this magic internet money. He runs the numbers, looks at the data, and he just walks away. Why?
It all comes down to his fundamental DNA as an investor. Michael Burry is a strict book value investor.
Meaning he wants to see real numbers.
Exactly. When he evaluates an asset, he is looking for tangible, measurable reality. He wants to see physical assets he can liquidate if things go bad.
Like buildings, inventory, that kind of thing.
Right. He looks for predictable cash flow. He wants a solid balance sheet showing revenue versus debt. So when he analyzed Bitcoin in 2013, he found an absolute vacuum.
It's just empty space.
Literally. There were no physical assets, no earnings reports, no CEO to fire.
To him, it just didn't compute as a revolutionary currency. It registered as a historical financial bubble.
Yeah, he actually compared it to the Nifty 50.
Oh, right. Those 50 massive popular stocks in the 1960s and 70s.
Yep. Investors bought them regardless of their sky-high valuations, and they eventually crashed spectacularly. Or, even worse, he compared it to the Dutch tulip bulb mania of the 1600s.
So he looked for intrinsic book value and just found a giant zero.
He did.
But here is what I don't get. It has been over a decade since that 2013 meeting. You'd think a guy who relies on constantly updating his data models would adjust his framework by now.
You would think so, yeah.
Yet, reading the transcript from his 2025 appearance on the Michael Lewis podcast, he hasn't softened his stance at all. He completely doubled down.
He really did.
Let me pull the quote. He said, Bitcoin at $100,000 is the most ridiculous thing in the world. It's worth nothing. It's worse than a tulip bulb.
He completely refuses to assign it fundamental value, yes. Because in his mind, the parameters of traditional valuation simply don't map onto a decentralized network.
It almost feels like he's using the wrong measuring stick entirely.
How do you mean?
Well, evaluating Bitcoin using a traditional book value framework It's like trying to calculate the financial value of the early internet in the 1990s, but strictly using 19th century railroad accounting.
Oh, that's a great way to put it.
Right. If you're only looking for physical train cars, miles of steel track, and literal ticket sales, you're going to completely miss the underlying mechanism of global connectivity. Did his absolute reliance on finding a traditional balance sheet just blind him to the psychology of the market?
That is the exact blind spot he actually acknowledges now.
Really? He admits that.
Yeah. He does. He was obsessing over the lack of physical assets. And by doing that, he completely missed two massive psychological forces driving the market.
Okay, what was the first one?
First, he underestimated the power of decentralized marketing.
The community aspect.
Exactly. The way a community can artificially sustain the value of a network simply through collective belief.
Right.
And second, and perhaps more importantly, he completely discounted the public's deep-seated distrust of the traditional banking sector following the 2008 financial crisis.
The very crisis he actively bet against and profited from.
No, it's a profound irony.
Yeah.
Satoshi Nakamoto, the pseudonymous creator of Bitcoin, literally coded the Genesis block with a reference to bank bailouts. The system was engineered to be what Nakamoto called financial sovereignty.
But Burry just saw an empty spreadsheet.
Exactly. And this is why his 2026 thesis demands your attention. He knows he miscalculated the psychological demand for an alternative to banks back then.
So he's making up for lost time.
Yes. He has spent the last decade tearing apart the mechanics of what happens when that alternative actually integrates with the banks it was supposed to replace.
So if Burry admits the public just wanted an alternative to traditional banks, how did Wall Street manage to take that anti-bank asset and turn it into the ultimate institutional liability?
That's the billion-dollar question.
Because over the last decade, Bitcoin was sold to you, to me, and to Wall Street with a very specific narrative. It was branded as digital gold.
The ultimate safe haven.
Right. But that digital gold narrative is the exact cornerstone of Burry's current panic, isn't it?
It is. Let's look at how actual gold functions in a traditional portfolio. Historically, gold is a hedge.
Right, a safety net.
Exactly. When inflation spikes or geopolitical tensions rise or, the tech sector looks shaky, investors get scared.
Naturally.
And their fundamental reaction is to sell their risky, volatile stocks and buy gold to protect their capital. It functions as a financial shock absorber.
So if Bitcoin is truly digital gold, the data should show it behaving the exact same way. When the stock market drops, Bitcoin should rise, or at least hold steady.
Right.
But Burry's data completely shreds that assumption.
The numbers show Bitcoin doing the exact opposite. Burry's models demonstrate that Bitcoin correlates positively with the NASDAQ.
So they move together.
Yes. In finance, we talk about an asset's beta, which is just a metric measuring how wild a ride an asset gives you compared to the broader market.
Okay.
A high beta asset like Bitcoin means if the stock market sneezes, Bitcoin catches a full-blown fever.
Wow.
It is fundamentally a risk-on asset. When fear enters the broader economy, institutional investors don't flee to Bitcoin for safety. They liquidate their tech stocks and they aggressively liquidate their Bitcoin.
Wait, so all those traditional fund managers,
Yeah.
the ones who recently bought up billions in those newly approved Bitcoin ETFs,
Yeah, the mainstream guys.
they fundamentally miscategorized the asset. They bought into these funds thinking they were adding a safe, stabilizing hedge to their portfolios to protect their clients against market downturns.
What's fascinating here is they baked a highly volatile tech asset into their conservative risk models, treating it as a stabilizer.
It's like building a massive cargo ship and deciding to use gunpowder as ballast.
That's entirely it.
Sure, it's heavy and it sits in the hull, giving you the illusion of stability on calm seas. But the second you hit rough waters and a single spark flies, your so-called stabilizer is the exact thing that blows the ship apart.
And that structural miscalculation by Wall Street sets the perfect stage for the disaster Burry is predicting.
Because they misunderstood the core nature of the asset.
Right. Because Wall Street wrapped a high beta, risk-on asset in the respectable clothing of an ETF, we arrive at his terrifying 2026 warning.
The death spiral.
Yes. He is mapping out what he calls a death spiral, which is a mechanical three-step liquidation loop.
Okay, let's walk through this loop for everyone listening. Step 1 is the trigger.
And according to Burry's models, the trigger doesn't even require a black swan event.
It doesn't.
No, it just requires a sharp price drop. He specifically models a 40% drop from recent highs.
Now, in the crypto world, a 40% haircut is basically a Tuesday.
Right, it's historically common.
Normally, retail investors just hold on and wait for it to bounce back.
But step two is where the new Wall Street reality takes over, because retail investors aren't the ones dictating the market anymore.
Right.
Step two is forced liquidations. And this begins with the foundational layer of the network, the miners.
Wait, why are the miners forced to sell? I thought the whole point was that they stockpiled the Bitcoin they mine.
They do until the math forces their hand. Bitcoin mining is no longer a couple of guys with graphics cards in a garage.
Right, it's massive now.
These are industrial-scale, publicly traded operations. They run massive warehouses of ASIC computers that consume megawatt hours of power.
Which means they have massive fiat currency electricity bills.
Exactly, and Burry's data calculates that once the price of Bitcoin drops below the $50,000 to $60,000 threshold, a mathematical trap snaps shut.
What happens at that threshold?
The energy cost to compute the cryptographic hashes suddenly exceeds the financial value of the algorithmic block reward they receive.
Meaning it literally costs them more to keep the lights on than the Bitcoin they're mining is actually worth.
Exactly. They completely lose the luxury of holding. To avoid bankruptcy, these massive mining corporations are forced to dump their Bitcoin reserves onto the open market just to pay their utility bills.
And I imagine this sudden flood of supply drives the price down even further.
It does, but the miners are just the first domino.
There's more.
Oh, yeah.
Oh.
The real devastation comes from the heavily leveraged companies and hedge funds that borrowed money to buy Bitcoin.
Ah, the leverage.
Yes. When the price drops 40%, the banks that lent them that money issue algorithmic margin calls. They demand more collateral immediately.
And this leads us to step 3, which is where this stops being an isolated crypto problem and becomes a your retirement account problem.
The contagion?
Step 3 is contagion to the real world. Because crypto doesn't sleep. It trades 247.
And that 247 nature is the exact catalyst for the contagion.
Walk us through it.
Okay, imagine Bitcoin tanks by 30% over a weekend. Traditional markets close at 4 p.m. on Friday.
Right.
But the banks issue these algorithmic margin calls at 3:00 a.m. on a Sunday. The hedge funds holding massive crypto positions are suddenly staring down billions in debt, and they need traditional fiat liquidity instantly.
But they can't sell their Bitcoin because the crypto market is in free fall and there are basically no buyers.
Exactly. So come Monday morning at 9:30 a.m. when the traditional stock market opens, what do?
They start fire selling their good assets.
Yes. They liquidate their blue chip stocks, they liquidate their bonds, they are forced to sell their physical gold just to cover the crypto hole that opened up over the weekend.
And Burry actually documented this mechanism in action, right?
He did. He pointed to recent sudden drops in the price of physical gold and silver.
Which didn't make sense at the time.
Right. Analysts were confused because inflation was high, so gold should have been soaring.
But Burry showed the drop wasn't caused by traditional macroeconomic factors.
No. Gold dropped because over-leveraged funds were desperately liquidating their precious metals to get the cash needed to cover their bleeding Bitcoin positions.
Wow. Let me read this simulated quote from Burry in the source material because it perfectly captures this mechanism.
Please do.
He says, "The idea that Bitcoin is a substitute for gold has failed miserably. When the storm hit, Bitcoin wasn't a safe harbor. It was the anchor that sank the ship of precious metals."
Connecting this to the broader financial plumbing completely shatters the illusion of crypto isolation.
It really does. The old comfort blanket for traditional investors was always, well, if crypto crashes, who cares? It only affects the crypto community.
But Burry proves that because Wall Street has integrated Bitcoin into the foundation of its portfolios, a crypto crash aggressively drains liquidity from traditional safe haven.
It creates a vacuum that just pulls everything down.
Exactly.
But how did we get to a point where a digital token, which was invented to bypass the financial system, could literally sink the price of physical gold?
It all comes down to who is actually holding the bag in 2026.
The ownership landscape has mutated entirely from what Burry saw in 2013.
Completely. We're looking at a fundamentally different risk profile now. Burry highlights a chilling statistic defining this 2025-2026 window.
Lay it on us.
Almost 200 publicly traded companies now hold Bitcoin directly in their corporate treasuries.
That's insane.
200 major companies have tied their corporate balance sheets and their shareholders' equity to a high-beta, highly volatile digital asset.
And the absolute poster child for this strategy is MicroStrategy. They've essentially transformed their entire corporate structure into a leveraged Bitcoin holding company.
They have.
But how exactly are they doing it? They aren't just using their profits to buy crypto.
Oh, no. They are using leverage. Companies like MicroStrategy issue what are called convertible senior notes.
Okay, what does that mean in plain English?
In plain terms, they issue IOUs to Wall Street. They borrow billions of dollars in cheap fiat currency, and they use that borrowed cash to buy Bitcoin at the top of the market.
So what happens when Burry's 40% drop hits a balance sheet built entirely on borrowed money?
The mechanism of doom is triggered by corporate accounting rules.
Right.
If Bitcoin drops significantly, the fiat debt they owe Wall Street doesn't change. They still owe those billions, but the asset holding up that debt is now worth half as much.
Ouch.
Yeah. These companies are forced to record massive, multi-billion-dollar unrealized losses on their quarterly earnings reports. Their balance sheets become instantly toxic.
Here's where it gets really interesting. When a company's balance sheet looks that radioactive, traditional capital markets freeze them out.
Exactly. Banks won't issue them new loans. Wall Street won't buy their new bonds. They are completely cut off from traditional capital.
Which leaves them with only one mechanism to raise the cash required to service their existing debt.
They have to sell their Bitcoin.
Right. These massive corporate treasuries are forced to dump billions of dollars of Bitcoin supply directly into a market that is already experiencing a liquidation cascade from the miners and the hedge funds.
It just accelerates the plunge.
Listening to the sequence of events, it sounds eerily familiar.
Does it?
This is the exact same architectural weakness Burry found when he shorted the subprime mortgage market.
Oh, absolutely.
Back in 2008, the entire global financial system was propped up by overpriced suburban houses. The house was the flimsy collateral holding up a massive derivatives market.
Yes.
Now, in 2026, the collateral isn't an overpriced house in Florida. The collateral is Bitcoin. If the collateral's value suddenly vanishes, the leverage unwinds and the whole system auto-destructs.
He literally calls it a collateral death spiral. The structural math is nearly identical, just with a different asset swapped into the foundation.
Wow.
And Burry's analysis points out an incredible irony here. For over a decade, the crypto community relentlessly cheered for Wall Street adoption.
They begged for it.
They demanded ETF approvals. They celebrated when corporate treasuries bought in. They absolutely craved mainstream institutional validation.
And that very validation is what stripped the asset of its original purpose. Wall Street adoption killed Bitcoin's purity.
It really did.
It is no longer an independent, decentralized asset floating safely outside the banking system. It is now just another highly leveraged cog inside the traditional financial machine.
It adopted all the vices.
The immense leverage, the algorithmic margin calls, the debt spirals, basically everything that Satoshi Nakamoto originally invented it to escape.
We really need to take a step back and look at the entire board here.
Yeah, let's synthesize this.
We've traced the 2013 valuation miss, the digital gold miscategorization, and the precise mechanics of this 2026 collateral death spiral. Bringing it all together into a final synthesis, we have to ask, is Michael Burry simply hoping the market crashes so he can finally buy the asset he missed at a discount?
Or is he a true visionary, seeing the underlying math of a disaster?
Right.
Well, Burry's mechanical diagnosis of a liquidation cascade, the interplay between mining thresholds, 247 margin calls, and corporate treasury accounting rules, it's mathematically sound.
The logic holds up.
The structural risk of 200 companies heavily leveraging a volatile asset is very real. But does his thesis overreach in its final conclusion?
Okay.
Because he isn't just predicting a crash, he's predicting Bitcoin goes to absolute zero.
And predicting a drop to zero ignores the entire historical behavior and technological architecture of the asset.
It survived crashes before.
Exactly. Bitcoin has acted as a financial phoenix time and time again. Burry is evaluating it purely as a line item on a corporate balance sheet. But he's ignoring the decentralized reality.
The network itself.
Right. Bitcoin operates on a global network of independent computers called nodes that maintain the ledger. As long as those nodes are running the software somewhere in the world, the network functions.
It retains utility.
Yes. It can't go bankrupt and cease to exist the way a traditional corporation does.
So what does this all mean for you listening right now? Why should you care about a billionaire's mechanical breakdown of a crypto collapse?
It's a great question.
I think it comes down to arguably the most famous investing principle of all time, courtesy of Warren Buffett, who, by the way, also famously despises Bitcoin.
True.
Buffett's rule is simple. Be greedy when others are fearful.
And Michael Burry is currently manufacturing an unprecedented level of institutional fear.
Exactly. If the architect of the Big Short, the guy who uniquely understands the underlying math of market contagion, is screaming about a death spiral across financial media, he might be entirely right about the impending crash.
The liquidation cascade might happen exactly as he models it.
But that crash might actually be setting the stage for the greatest transfer of wealth we've seen in a generation.
Oh, so?
Well, think about it. If massive institutions, the corporate treasuries, and over-leveraged hedge funds are forced into algorithmic liquidations at rock-bottom prices just to cover their fiat debts, someone has to be on the other side of those trades.
Right. And the data suggests the buyers of last resort would be the retail investors.
Regular people.
Yes. The individuals who avoided the leverage, maintained their liquidity, and just waited for the institutional whales to bleed out. If the major funds are forced to sell, the retail public could scoop up the pieces at an incredible discount.
The ultimate irony, right?
Yeah.
The institutions bought in, pumped the price, got massively over-leveraged, and the mechanics of their own greed might force them to transfer it all right back to the retail public.
It would be historic.
But wrapping up this deep dive, there is one final lingering question we have to ask about Michael Burry. It's kind of the mathematical elephant in the room.
If his models are this precise and his certainty is this absolute, where is his capital?
Exactly. If Burry is an absolute mathematical genius, and he has fundamentally proven that this death spiral is going to drive Bitcoin all the way to zero, why isn't he heavily shorting it?
That is the big mystery.
We know he shorts things. Finding the flaw and betting against it is his entire claim to fame. Is he simply terrified of getting burned by the irrational psychology of the crypto community like he did in 2013?
It's possible.
Is the trauma of missing the greatest trade of the decade keeping his wallet closed? Or, deep down, despite the public warnings, despite the rigid book value models, despite comparing it to tulip bulbs, does the ultimate contrarian secretly hold a cold wallet tucked away in a desk drawer somewhere just in case the guy in the cargo shorts is wrong again?